Danielcode webinar. I'm delighted to have you with us today. My name is John Needham. I'll be your host for today. And let's see what's happening here. We've got Bo. Hello, Bo. Saying he's trying to stay awake with Swedish glog, Glogg. Ah, is that grog? Might be something worthwhile there. Okay. So let's see how we're going. We've got all our usual folks here, and I'd be most grateful if one of you would type in the question box that the volume's okay, that you can hear me. And we'll see who we've got here. Oh, we've got a big turnout today. Bo's with us, of course. Bob is with us, and many Bobs. David Huslocki is here with us. Glad to have you with us, my friend. George Tarr, haven't seen you for a while. Thank you, mate. Yes, you can hear me all right. That's grand. Let's see where else we are. Oh, Jeff's with us. Jeff is a farmer, a grain grower, and a cattleman. And he's just finished his Danielcode TTT Learn to Trade video series. So it's glad to have you with us, my friend. Joe's with us. Many Joes are with us. Lots of Peters. Justin down in the Hunter Valley. Justin, thank you so much for that wonderful response you gave me to my question to you at our last webinar. I've read and reread your comments at length, and I think what you're doing is absolutely incredible, my friend. I am most grateful to you, and I trust you're well and happy. Mark L's with us, one of the pioneers of Danielcode time trading. Glad to have you back with us, Mark. You had a day or two away visiting family, as I remember. Nathan's with us. Good to have you, mate. Oh, Norbert up in the really cold country in Canada. Well done, my friend. Glad to have you with us. Stephen's with us. Another Stephen's with us. And Vicky's with us. Haven't seen you for a couple of sessions, Vicky. Glad to have you with us. That's terrific. So yes, welcome, folks. Well, interesting times, don't you think? I certainly do. I think we're in the process of some very serious market effects, and I've recently been spending a lot of time thinking about what other people do in their trading. I'm talking about the big boys, you'll remember me telling you that the 20 best hedge funds in the world for fiscal 2024 made 8.5% return on investment, and they had with fees of about 4% to come off that. So they're the people who are doing the advising for all the big hedges, and it's not very good. In fact, it's pathetic. So I didn't expect to find anything earth-shattering, and I was right. To me, it's quite amazing how simplistic their market analysis is. And I'm going to devote a whole webinar shortly. It'll be an extra webinar, maybe sometime over the holiday period, to just talk about what the traditional market analysis is. And it's very much based on really simple concepts of trading: trend lines and correlations. In many cases, they simply have so much data that their correlations become useless, because instead of saying, well, we're looking for 1 or 2 correlations for this market, they can roll up with 20 or 30 different charts, all of more or less levels of relevance. But it largely defeats the whole purpose. But they're always looking for some little edge, and no, it's not very sophisticated at all. But that will be for another day. So we shall move on here to see what has happened and what is coming down the line. So markets, as you know, I tell you this every webinar, so I'm sure you know it now, markets are rational, orderly, and sometimes predictable, and survival requires strict adherence to the rules. And I think that's a thought I'd like you to hold in your head, because I think we could possibly be on the verge of some tumultuous events. This slide I've shown you a couple of times before, and it's a permanent part of my webinars now, and in it there is no such thing as artificial intelligence. It's just Google on steroids. And who said that? I did. And the quote below is not from me. It's from one of the biggies. Astonishingly large numbers. It will take $5 trillion to fund the AI cycle. And the US government is on the hook for over 1 trillion. Think about that. If you can even contemplate such numbers. To me, I get all blurry over 40 or 50 million. It's beyond my comprehension. But this is not new. This particular slide, you've been seeing it for quite a while. And all of a sudden, it matters. And it seems to be one of those things that doesn't matter until it matters, which is a silly thing to say, you know, but you'll understand what I'm talking about as we move along. So this is a chart I showed you at the previous webinar and the one before that. And this is the S&P index, the chart for that. And you can see we've had a couple of interesting periods where we've had a big correlation of the time cycles that typically turn markets, that typically end major trends. And you can see we had a bunch of them in early November. And I put on a comment about that time saying hard hats required shortly. So this is just another version of the same document updated. And you can see that if you take your eyes past all the 59s I've got and the 88 I've got wrapped up in little blue ovals, you can see the next two lines are 62. And 62 is a terribly interesting number for us because it's the alternate to the 59. And for those of you who've done the Danielcode tutorial, you will know that 62 comes from the rule of eighths, which is a vitally important part of market law for until recently in market terms, by which I mean 50 years or less. All stock markets worked on 8ths and 16ths, and Gann and Jesse and all the big names that we have passed into market law, that's how they were trading. They were trading 8ths and 16ths. And the rule of eighths actually comes from Daniel's code. For those of you who've done the tutorial, that's the first group of numbers you'll see. And two of the numbers from the rule of eighths, 37.5 and 62.5, have become important largely because of the popularity of Elliott wave theory. And for the last 45 years, we've been forcing anyone who wanted to work in the industry to pass an exam which includes Elliott wave theory, which I don't wish to denigrate anyone, but that's one of my least favorite things in life because it's rather flawed, but nonetheless, it's widely accepted. But it works on these Fibonacci ratios, which Elliott thought had some semblance to market movement. In fact, those of you who've done a tutorial with me will know that Fibonacci ratios really are compiled from the Fibonacci sequence, which is all about the procreative ability of rabbits. And I'm not kidding, or perhaps I'm kidding, but that's a good reason as any. But these whole magic and wonder of time cycles, and if you're interested in it, there's an article under the articles tab at the Danielcode website called The Other Way, and it's an analysis I've done of long-term trading, really long-term cycles. And 59 has, since the 1900s, been the dominant time cycle that ends major moves in markets. But there's always a subtlety in these time cycles. There's always something hidden away that prevents the great unwashed, the great masses from understanding. And that's the purpose of it. Like pretty well everything else in the market, one of the important jobs that the market does is get the majority wrong. And it seems to me it might be quite poetic for Daniel's time signals, Daniel's code, which is the only thing that will ever end this great bull market that we've been in for so long, to just slip away from the 59 and land on the 62. And if that's the case, you can see also, this is a chart from last webinar I did, and a couple before that. We've been showing you this chart for quite a while. And you can see that after the 59s, there are two dominant, very powerful 62 cycles on this chart, one of which is just completed, and the other one has just become active. And I'd be really, really thrilled to see the market slip that trick in, that missed the 59 and go to the 62. These cycles, of course, are all running from the COVID flash crash, which is a very important inflection point now. So keep in mind that we are, in my view, at a high probability of an end to this historic bull market, or at the very least a serious correction. And the market has got so overbought and has been for so long that a serious correction is the very least that it needs. This is the daily chart, and you can see that we had a nice run up on our trading, and then we had some real resistance at these black lines, these famous Danielcode black lines. And they're famous for two reasons. In the first place, they're famous because I found them through Daniel's code, and I became frankly amazed at what these black lines do. They're like all the other numbers in the Danielcode ratio. They provide support and resistance to markets, but the black line has a particular quality, and that quality is that it is the last line of support or resistance for any market swing. And you can see that this market's just been hammering and hammering against that black line, and this is the second black line. In fact, this rally up encountered two black lines, which you can see here. Unfortunately, when I put the second arrow on, it's overwritten the first arrow, and it says 4 blur 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 sell, but it actually says 4 days that it's been sitting on a sell signal. And what I've shown you here is the 259 cycles, and that's from our the rally back up towards our recent high, and which I posted on the front page of our website saying hard hats needed shortly, and we got a decent pullback out of that, but it was a pullback that was dominated by bulls rather than bears. They bought every dip, bought every dip, bought every dip. I know I'm repeating myself, but that's how that particular bit of trading felt for a while. And you can see it's all stalled around the first black line, which was the retracement from the swing low to the first correction high of the pullback. And now it's been bashing its head against the black line at 6906. Well, what happened with the black line? Why it became famous? I can only claim part of the fame for finding it, but we have a wonderful story about it that Akshay, one of our very long-term Danielcode members in India, told me about. He was a very keen broker, did his Danielcode course and was working for one of the big merchant banks in India. I think Mumbai was where he was. 4 or 5 months after I released the Danielcode website to the public in late 2007, Akshay wrote to say that he had an amazing visit from a Bloomberg salesman, and he had Bloomberg data. Most of the big firms use Bloomberg, and this gentleman came to see him and said, "We've got a wonderful new product, and what you do is you take this number and you multiply it by your mother's age, and you subtract any number that you can think of if there's a full moon, and guess what? You'll finish up with 89. And it was just complete reverse engineering of the Danielcode black line. But of course, as soon as Bloomberg added it to their data portfolio and their data service, it became famous because half the world knew about it. I can't claim credit for that, but that's where it came from. But it's amazing just how strong it can be, and in this case, it's been holding back this market for a while. This is the 6-day chart of the S&P, and you can see that for the last 2 periods at least, the market's just been bashing its head against that same black line that you saw on the daily charts. And one of the peculiar characteristics about the black line is that if the market clears it, if it closes above it in this case, or below it if the market's correcting, it switches the odds massively to the proposition that the swing high to which that black line belongs will be taken out. And that doesn't mean a whole lot in terms of daily charts, other than it explains market behavior in a very rational way. But on the longer term charts, it can be quite significant. And some of you will remember the action with the black line in the gold charts many years ago. But that particular point finished up being a $28,000 trade per one contract, which was pretty interesting. So be aware of it, and we'll see what happens with it. So we're right in the time cycle for a potential high here that could end this major bull market. And one of the interesting things today is that whilst NASDAQ and the S&P were completely subdued, the Russell had another one of its very excitable little breakouts on the 24-day chart. And this is the 24-day chart. This is what we call the long-term trend chart. 24 days, every single bar on this chart is comprised of 24 trading days. And you can see that the Russell as well is sitting right in that 62 period time frame. And what that is telling you is that it is one of the Danielcode ratios, one that's been prominent over the years in starting or stopping significant moves in the equities markets in particular. And Russell is now sitting exactly on the 62, and that's a 24-day chart, of course, a long-term trend chart, from the COVID flash crash. For those of you with really keen eyes, you'll see that I'm running the COVID flash crash from the low of the COVID flash crash, whereas the number when it created, when we had that wonderful 24-day, the shortest bear cycle in the world with COVID, the second coming of COVID, that happened on the highs. So for all of our other charts, you'll see S&P, etc., that time cycle is working from the highs, which is where we picked up that major cycle that enabled us to trade that COVID flash crash for the lot, for all the lolly. It was wonderful. So the Russell's in that position now, but on the next cycle, the 62 cycle, and that's on the long-term chart. It's also sitting on a 44 cycle on the 6-day chart, and having both those cycles in tune with each other just makes the proposition that much stronger. But if anyone's counting on the Russell to save the rest of the broader markets, you're dreaming. Look, I mean, it made its significant high back in November 2021, and here we are 5+ years later, or almost exactly 5 years later, I should say, before we had a concerning breakout, which is what we've got now on the Russell. So it's been a laggard because, of course, the Russell is the 2,000 small cap stocks that are in the Russell index, and that is more representative of reality, because what's happening with AI stocks and crypto type stocks, they are in a full-grown, in my view, incredible long-term bubble, and despite the protestations, I think that there has to be a reckoning, and it might be much sooner than everybody except Frank and I think, put it that way to you. So here's a sign of the first crack in the wall. This is from one of the big, seriously big boys, Oracle, and this is the comment from Zero Hedge today, that this is the one of the absolute leaders of the AI investment boom, which is spending many times more than its estimated free cash flow to fund the build out of AI, the data centers, the power that's may be required to run these data centers if they're ever completed, etc., etc. And it came out with its financials today and said that its CapEx, its expected capital expenditure, was massive, was many times more than the analysts and investors had previously expected. So until today, those estimates were at 8.8, nearly 9 billion, but today they've jumped to 12 billion, and all of these estimates are notorious, particularly when you're building something physical like data centers and all the software that has to go into them. They're notorious for being on the light side. So that's the first crack in the wall, really, for the big boys, and it looks pretty scary. But to me, it's just somebody, more than one analyst, obviously, not many more than one, but Goldman has in it, and there were some people who, it might be in Deutsch, who had this 2 weeks ago, actually sat down and started thinking about what these estimated costs to build out what is thought to be required for this great AI revolution, and put some dollar numbers on it, and it's scary, and more than that, it's ridiculous, and you can see this whole narrative about artificial intelligence. That's been driving the top end of this market for years. And what you've got now is Trump. You've got Trump in as president, and he's very pro-business, of course. He looks at the American economy as he would a business. And his administration has certainly green-lighted mega tech to embrace growth and borrowing at pretty much any cost. And don't forget, one of the things that we've seen recently with Trump is him saying that if we're going to give money to important industries that require government support, we want a return. And for the first time, he's saying we want to take equity as our return. So the government is getting its left fist and its right fist right into the tar baby, and those of you who are old enough to remember the Tar Baby stories, well, don't run up any stairs, because you're like me, at an age when we're maybe not quite as hearty and physically adaptable as we used to be. I think that's the most polite way I could say it. So megatech and the not so mega followers, they're all in on AI. And the commitments in this very permissive fiscal environment, where Trump has neutered the regulators and really sidelined Congress. And look at that with the highly competitive nature of tech leaders, has them out on a limb with quite amazing projections of what this cost is going to be. And the cost is not only the physical cost of building data centers, they've got to be equipped, they've got to have electricity, they've got to have cooling, because you put a whole lot of servers in an enclosed space and they create heat. And this future capital requirements is way beyond anything that's been thought of as a business proposition before. And it is what it's creating is a wholly new business model that is light, I've said think invisible, on where and what the dollar earn will be. And you know, ChatGPT has been running for years now. What has changed for the big dollar products? I mean, we understand the large language model, and that really, I think seriously, is Google on steroids. What else is it going to do for us? Well, one of the things about AI is it certainly has application to defense products, and that's what links the government in. There is a arms race in AI, certainly between the US and China. And the reality is that China is doing as well, if not better, than the US, and it's doing it on the cheap, which is extraordinary. And those of you who follow these sort of subjects will know what I'm talking about. So I think what we're looking at the moment is .com top, from the .com top, part 2, and that top came in the year 2000. And for those of you who are old enough to remember it, in the S&P and NASDAQ, think about the massive outcomes. Many corporations went broke. Many corporations went broke. But massive fortunes were made by the early players. Innovation was everything, and huge strides in technology were made. The internet per se was and is truly life-saving, but most of the products that came out of that were just a better mousetrap. In other words, we had a product that did that job, whether it was manual or automated in some way or mechanized, but it produced a better mousetrap. It didn't change the world. And AI is now occurring in the most permissive environment due to Trump's basic nature as pro-business and anti-regulation. But he's already shown his willingness to put the government credit card on the line for these megas. And that is wholly sensible in a largely unregulated or laissez-faire type business environment. But think about this, lying has many forms. Lying can be intentional with the intent of misleading. That's common in market shenanigans. It can be a white lie that's made for the purpose of saving others from embarrassment, or even saving oneself from embarrassment. And of course, the most obvious one is lying by omission. And with all of these corporations, we're terribly reliant on what the management, the leaders of those businesses actually say. And auditing as the safeguard has been shown to have some holes in it. It's not the ultimate answer, because someone who's prepared to lie to his shareholders will think lying to the auditor is a drop in the bucket. And that scares me. And I know all about it. I've been the CEO and chairman of 2 listed public companies during my life, and gone through those forms of stress of talking to your shareholders, telling them how the business done, trying to make excuses when it hasn't reached its forecast, and then dealing with auditors in the intent of getting the best outcome for your shareholders. So I know something about that, and it can be very difficult, and it can be very difficult with very good intentions, and that's the big risk that's happening at the moment, because the projections that some of these megas are making are so far out of line with any previous understanding of the value of a dollar that you can't contemplate it, you can't calculate it. I mean, the numbers are just so massive, but I guess we'll see. But I think you've got to have more than one eye open at the moment, because this could go very wrong very quickly. Okay, here's what we've been doing with ourselves in the last few days, folks. We're showing you short crude oil, and that's a really interesting play for me, and I'll tell you why. This is the 6-day chart of crude oil, which we publish. These charts are published twice a week. And a long time ago, in terms of the 6-day bars, 7, 8 bars ago, this would be October, we had a close below that black line on the 6-day chart. And a close below the black line shifts the probabilities massively towards the view that the swing low will be taken out. And that swing low is in the mid-50s. So we could see something quite unusual in petrol prices. We know there's a world glut of petrol and oil, but that I've left that 57.69 number with one of the blue ovals around it to draw your attention to it, that the market's already closed below that number. It's a very high possibility that it's heading for the all-time, or the more recent lows anyway, which are around $55. Something to think about and keep in mind. Okay, this is what's happened in copper. We had a sell that didn't quite reach the blue lines, which is always a sign of weakness. If the high is struggling to find a level and it can't quite get there, that's usually a sign of weakness. And from that, of course, you saw the inevitable correction. This is natural gas, which has been a wonderful trade. We had about $4,000 in the last rally up. And this trade at the moment from the TO3 and blue line signal is already at $8,000 in 4 days. Pretty wonderful bit of trading, isn't it? I do love this. Unfortunately, it's now hit one of the black lines, the minor black line at 42.11. The major support is down at 440.87. So see what it does when it finds those numbers. This is the NASDAQ, which I was just talking to you about, a sign of weakness when markets can't find these blue numbers. And this market's had 1, 2, 3, 4 really solid goes at its blue line, which is considerably below the black line, but it's been trying to reach its blue line numbers, has not been able to do that. That's a sign of weakness, which is why today we got some form of minor correction. This is the next one. This is the Russell, which they're yodeling about it being a breakout day. Well, I guess it was. I mean, we've been long this since mid-December, early December, late December, somewhere around there, mid-December really. And it's had a couple of minor corrections and we're long again. So it's having its moment, but this Russell has so badly failed to match the performance of the other indices that it's really showing you that we've got a 2-speed economy, at least. I mean, maybe it's a 10-speed economy. if you go into the micro level. But you've really got the mega stocks, the big tech stocks. That's one world, and even that world's weakening if you see what Nasdaq is doing. And then, the other end of that extreme, you've got the Russell, which is the small caps, the 2,000 companies on the New York Stock Exchange with a smaller levels of capitalization. Quite different worlds altogether. This is soybeans, which has been in the news lately because Trump is trying desperately to get the Chinese to honor their undertaking that they'd buy large amounts of soybean. The Chinese is a huge market for soybeans. They use it as food for pigs, and pigs are such a huge part of their diet. And Trump's recent meeting with China, they made some pretty strong undertakings that they buy massive amounts, and it hasn't happened. And farmers, soybean farmers, are in serious trouble. This is the second year the crop's coming in. There's nowhere to store it because storage from last year's crop is full, and there's some real serious problems. The government, Trump has just announced a major financial relief package for soybean farmers in particular, and they need it. And I sympathize. I've been a farmer myself for many years in another life, and it's tough. I'll tell you, it's tough. And all of those grain growers, I mean, we've got Jeff with us, he's one of them, and others, of course, and they're getting an absolute toweling. How are you going to fix that? Well, if you think about soybean, it's a hugely capital expensive product. You've got to have the land, you've got to have the machinery working down the list, you've got to have finance to pay for the new crop that you're planting, and the sprays and the chemicals and the fertilizer. It's all capital intense. And what's happening at the end of it? You're selling this product predominantly to an overseas buyer who's been about the kindest thing you can say is unreliable for their own purposes. This is not happening by accident. This is part of China's strategy, policy to weaken the US whenever and wherever it can. And where does all this wonderful, hugely expensive product go? To feed pigs. It's like wheat that doesn't make the grain, doesn't have the right protein level. It goes as animal feed. It's wholly disheartening, the whole cycle. But it's also very specialized. Some of that equipment can't be used for much else. Anyway, the people who are mining silver are all happy. Have a look at this for a decent big blowout. So what we had on this market was a correlated buy, by which I mean markets hide their true intentions when they can. And sometimes, as I was telling you, correlations become very important. And I think I was indicating to you that the big boys, really serious big players who run the market, leaders, rulers of the world, if you like, they are very, very invested in correlations. In fact, they go to enormous lengths to try and find correlations because sometimes that's a cleaner way of getting the signal. And what happened here is that gold created a buy signal and silver did not. It was overbought and showing a bit of a loss of momentum, but gold clearly had the buy signal there, and that's why this was a correlated buy. Because gold and silver are so highly correlated that you can trade the Danielcode signals. If they're active in one, you can trade them in either or, provided the trade is elected, by which I mean the number is reached where you need to go to find fulfillment. Because remember, all of the Danielcode signals are conditional, and they're conditional on what we call market election. In other words, they have a number that comes with the signal that says, if you're going to buy this market, buy here. or if you're going to sell this market, sell there. And we require the market to get to that level to fulfill the order. And that's why it is so interesting the way Danielcode can find signals through correlations. In this case, a very nice trade, $24,000 odd per one contract from a signal that came in gold. The same thing happens in equities that are so highly correlated directionally that a signal in any one can be taken and executed in any other. So there's silver's having a real roar, while gold has a little bit of trouble at the moment, mustering much excitement. This is UST bonds. We had a nice little short trade, and we're currently long, and the market roared away today, hit the Danielcode retracement level at 115.08. Said that's it, bye-bye, ta-da. Down it went, and we're left looking at a large bar that is a key reversal bar, and that's not exciting if you're long, which we are, but we'll see. This is what's happening in the 6-day chart in UST bonds, and you can see, if you haven't seen this chart before, it's extraordinary that all over it, every high, every low, is coming in with 1 tick variance from the Danielcode number, 2 ticks variance from the Danielcode number, 0 variance from the Danielcode. It's quite extraordinary. Today we've got a 1 tick variance at the close with 1 day to go. And don't forget, target recognition is valid at the bar, high, low, or on the close. So either or are quite valid. You can see the little high that's running just 2 bars before the current bar. It gave its 1 tick variance on the close, and this market's shaping up to do thing in the present cycle. But these charts are published twice a week, and if you're interested in where markets are going to go and where those highs and lows are going to be, you should look at subscribing to these 6-day charts. They have been quite extraordinary for a very long time now. So here's another one of today's headlines, that Altman, he's the chat GDP guy, goes full YOLO. You only live once. Is that an acronym for you only live once? Because China is building a top-tier AI for pennies, and the difference between the spending by US corporations and China, which is a huge competitor, don't forget. I often think that CEOs of all ilks in all countries often fail to realize that whether we like it or not, we're part of a global economy, and we have competitors, and that's who you're really competing against in many cases. And this is a biggie, this is a major. OpenAI has got such a massive cash burn, projected to exceed $488 billion by 2029. As they've highlighted here, you got a 1.43 billion cash flow with 200 billion potential by 2030 from data center commitments. And that is surpassing historical tech giants' losses of all time. Amazon and Spotify are the examples used. No startup in history has operated with losses approaching OpenAI's current scale. And here's the little note of warning from the writers of this, which Zero Hedge published. It came from one of the big boys. European subscription markets flatlined since May, with updated data indicating early OpenAI subscription figures were likely anomalous, signaling weaker market reception than initially projected. Or as one way put it, what is it going to mean if AI finishes being an $18 a month subscription for a bunch of kids to get AI to write their essays? Where is the big dollar? Where is the big dollar benefit? And certainly it's hard to see that in what's at the moment called large language models. There are other applications, but large language models is the most prominent. So AI matters and will matter. Goldman Sachs points out spending tail risk. CapEx reverting to 2022 levels could reduce S&P valuation multiples by 15 or 20%. And don't forget that AI stocks are now about 40% of the S&P 500 return since ChatGPT started. It's scary, isn't it? Have a look at that chart that they published for us. It is scary, and it's happening, and it's real. To protect yourself, learn to trade yourself so you'll be immune to the horrors and whims of misfortune. And you can start by, I suggest you go take 30 minutes out of your life and watch these webinars. These recordings, rather videos, which are on the front page, the home page of our website. And video number 1 is from Mark L., who's with us today, a long-time Danielcode supporter and very, very generous with his work. And in that video, he shares his research that he made while he was doing his paper trading, while he was learning how to create and trade Danielcode time signals. Video number 2 is from Justin, who's also with us today. Same thing, that he's shared his knowledge while he was doing his tutorial, learning and back testing Danielcode time signals on various futures models. And then video 4, which is extraordinary, that's again Justin. And what he's done is he's back tested Danielcode time trading methodology on all of the futures markets we trade, and more, some we don't trade, all of the Forex markets that we trade, and more, some we don't trade, and others. And he's taken in here for his back testing well over 100 years of data, by which I don't mean that he's 110 years old. I mean that he's done 1 year for some markets, 4 years for other markets, 8 years for some markets. In total, he's taken in over 100 years of real data and tested it and tabulated all of those results. Hasn't missed anything. Has, in his own words, he's made the results as bad as he could. In other words, thanks, Jeff. I'll be back to you in a minute. In other words, he was very negative. He was actually looking to prove that Danielcode was not very good. And he's come up with the entirely different solution and understanding that it is the best trading system in the world. Interesting comment here, folks, from Jeff, who's a grain farmer and cattle farmer. As I said to you, was just recently did his TTT tutorial. As he says, yes, he's talking about the massive funding, relief funding that Trump has promised. As he says pretty succinctly, yes, haven't got anything yet. Tough, isn't it? Very tough. Okay, so the answer to anything that's going to happen to markets, folks, is that you teach yourself to trade. And we've now released our TTT video trading series, which has been very, very successful. And you can do that at a fraction of the cost of the live one-on-one tutorials with me. And you've got to be prepared. And unless you've done a Danielcode tutorial, I'll tell you, you're not prepared. And once you've done the tutorial, you are immune from any harm in the market because you will be with the market almost all the time. And our risk control is such. I'm wondering if Greg from Texas is with us today, because he wrote to me very briefly. Gig's with us. Hello, Gig. Good to see you here, mate. I'm looking to see if Greg is with us. And a few newcomers, a late arrival. I hope you haven't missed anything. It's being recorded, folks, if you have missed anything. I don't think Greg's with us. And he wrote to me today exactly about risk going forward. Danielcode tutorial teaches you to control risk, and it's amazing, quite frankly. Watch that video for folks. That's not me, that's Justin, the client, and it's an extraordinary event that he's come up with. So this is our TTT series. You can read all this yourself. Most of you have got a attachment to your invitation that sets all this out, so you can read it at your leisure, or just go to the website, tick on the link that says teach yourself to trade, etc., and you can read all that at your leisure. Forex, for our long suffering Forex folks, I usually spend more time talking about futures than Forex, but I actually started off as a Forex trader, which is not uncommon. Greg Palladini, who's a wonderful stalwart Danielcode supporter, started off as a Forex trader as well. It's quite common. But Forex this last couple of weeks has been sensational. Have a look at this. The numbers are quite small because that's just the tool just assumes one contract. But look at this Aussie US dollar trade. I mean, it's just been lovely for a long time, and it's had a wonderful run up and a little bit of trouble around that black line, and that's to be expected. This is the Canadian dollar Swiss franc pair. We were long and we're now short, and there's money sitting in those contracts. This is the euro having an attempt to break out from the US dollar, and a lot of the sentiment in the US dollar is very negative. And I'm going to show you an alternate to that, or at least an answer to that, when we move along a little bit further. This is the British pound Japanese yen pair. Same thing, nice trade up, short today, and now flat. And see what happens. We know what to do when you're flat. Re-entry is a breeze once you've done the Danielcode tutorial or the TTT version. Both have essentially the same information. This is the loonie, the US dollar Canadian dollar pair, called the loonie, the national bird of Canada, and it's nice, isn't it? 1,600 down, another 300-400 today, all per one contract, and you can trade as many contracts as you like, folks. Don't think these numbers are small. You can multiply them just by trading more contracts. They're quite small contracts on the CME. This is the yen, and you can see it ran into a TO3 sell, worked its way down, and then had a little 3-bar rally, and ran straight into a TO3 sell again. So not all of these moves give you much money. This one had a nice run down, an even better run up into the high that created the TO3 sell against the blue line at 157 plus. And today it's elected the sell and then pretty well ran back up the page. But it come again. And this is the US dollar index, folks. We're very near ending, but I wanted you to have a look at this. There's an enormous amount of negative sentiment about the US dollar. And unfortunately, with this oval I've had on there for a while, it's blocked today's bar, which is so far just a little inside bar. This is the Danielcode trend chart. This is a 24-day chart. Each bar is 24 trading days. So this is giving you a really quite a long-term perspective. And you'll be able to see that this market was fighting around those red lines around 98, 98.3, 98.1 and you had two lows, a close, another close, an open, and that was 4 months of price data where it was holding support at that 98 level and then broke through it. Went down and still couldn't find the red line number, but what it found was one of the blue lines at 96.72, not far away from that at all, and gave it a TO3 buy signal, which has caused the current rally. And I think that that's a little difference in behavior. This market's been running off the red lines for years and years, since 2000. Really, it's been dominated by the red lines, both up and down. And now it's found one of the blue lines, which is a different kind of support. And it's not that one's stronger than the other, it's just that the markets will shift between them occasionally. And that's what's happened here. It's been hunting and hunting to find the support level. As I say, you can see 4 months of it there, 6 months really if you count the little failed push through and the inside bar after it, all around those dual red lines around 98, and now it's got a serious buy signal from a blue line, and it started to rally. I think that there's possibly more strength in the US dollar than the naysayers want to admit, and bear that in mind, you Forex traders. So that's us for today, folks. Thank you so much for being with us. If you haven't already, do help yourself to a free trial of the Danielcode. Just go to the website, www.thedanielcode.com. Just hit the register button. Any problems you have, contact Terry at support@thedanielcode.com, and he will get you sorted out. Finally, this is our disclaimer, which I really ask you to take seriously if you're new to trading. It is very, very easy to lose all of your money very quickly trading futures or Forex because they are leveraged. And leverage is a strong, sharp sword. It cuts for you and against you if you don't know what you're doing. The good news is that it's very easy to make a lot of money in futures and Forex trading once you know what you're doing. And the best way to learn is take a Danielcode tutorial. And if you're interested, let me know. I'll be happy to talk to you and get you started on this greatest of all adventures. And that's me for this week, folks. Do drop me a line at jneedham@thedanielcode.com, jneedham@thedanielcode.com. If you have any particular topic you'd like me to talk about, and I can prepare something for you. Okay, well, thank you for being with us. Thank you, Jeff. Hope that money comes through sooner rather than later. It's not going to be the answer to everything, but it's a big help for you. And that's it, folks. Enjoy your night of trading, my night, your day of trading still to come. And I look forward to greeting you and speaking with you at our next webinar in a fortnight's time. And of course, we're going to run into Christmas, aren't we? We've only got about 12 trading days to the end of this part of the year. And the next webinar, folks, is going to be on Christmas Day. So we better miss that. I'll have to shift it to either Christmas Eve or Boxing Day. And you'll be right in the middle of the festive season at our next webinar. How wonderful. What a wonderful year it's been. If you've been trading Danielcode, you've had a wonderful year. So thank you for being with me. All the best, and I look forward to seeing you on the next occasion. Bye-bye for now.